Hello, and welcome to the second in a series of webinars jointly sponsored by British International Investment and the Operating Principles for Impact Management. My name is Diane Damsky, and I head the Secretariat for the Impact Principles. Today's topic is Impact Scorecards, how investors assess impact. And we have a great panel of experts to lead this discussion today. And with that, I'd like each of the panelists to introduce themselves. And we'll start with you, Hjeltje.
Thanks, Diane, and welcome to everyone on the line. My name is Hjeltje Adriaans, and I am a manager at British International Investment in the Development Impact team.
Alessandro?
Yes, good morning, everyone, and thank you for the invitation. My name is Alessandro Maffioli. I'm currently the Managing Director for Development Effectiveness at IDB Invest.
And Veronica?
Thank you. I'm very happy to be here this afternoon with you. I'm the head of impact of BlueOrchard, and we are impact managers.
Now, we'll begin the webinar now with opening remarks from each of the panelists. And what I'd like each of you to do is provide an overview of your methodology for impact scorecards, impact ratings, to give everyone a sense. And if anyone has questions, please submit them while people are talking. That's fine. Alessandro, can we start with you?
Sure thing. And again, thank you very much. Maybe just a few words on what is IDB Invest. And so IDB Invest is the private sector arm of the IDB group. It finances projects, corporates, and financial intermediaries in Latin America and Caribbean. We have right now 16.3 billion asset under management, 394 clients throughout the region, and we work in 25 countries of Latin America and Caribbean. So our impact rating system, called the Delta, is Development Effectiveness Learning, Tracking, and Assessment tool, is a key component of a larger thing that we call our impact management framework. So this is an end-to-end series of tools and practices that covers the entire life cycle of our operations, from how we select deals to how we evaluate and generate and manage knowledge about what we learn from them until the final evaluation. So, and this framework is what allows the IDB Invest to build, measure, and manage a portfolio for impact, ensure learning from our operational experience, so we learn from what we do, and hopefully we learn to do better what we do, and of course ensure transparent reporting on the results that we achieved through our portfolio. So IDB Invest and its previous incarnation, the Invest, was created in 2016 as a consolidation of all private sector activities in the IDB group, started using impact rating and portfolio approach since 2008. So we are year 15 of been using this kind of tools, and with the ongoing work on the revision of the Delta towards the Delta 2.0, we are the fourth generation of this type of tools. So the Delta wants to be a rigorous, fact-based, data-driven rating system that assesses both the expected impact ex ante and the strategic relevance ex ante of our transactions, and tracks actual results during the execution of the investment that we are financing, including their contribution to the SDGs. So when we build and when we build this kind of tool, we look at three elements that are very important for us. The first one, that they need to be rigorous and credible. And so the Delta is based on, I would say, a well-known concept of an estimation of what is the economic and social rate of return. So the return to the society of the transaction, not the private return, but return to the society. So including the positive externality and excluding the negative externality of a transaction. Of course, we need to use some proxy there. And so this kind of approach, as a guiding principle, help us to first think in terms of net benefit. So benefit to the society minus the cost to the society of a certain investment. Think in terms of counterfactual. So what would happen in the absence of the transaction of the investment to the situation we're looking at? And think in terms of sensitivity and having a sort of risk adjusted impact because we run different scenario in thinking what would happen if some risk factor occurs. This is complemented by a stakeholder analysis, which look at the more intensely at the who is receiving the major receiver of benefits. I didn't mention, of course, the tool is in line with the 5-dimensional part of the IMP. And then I will say a little bit about also the sustainability and the additionality analysis we'll look at. Second element we look at is to be operational. I always say this, probably heard me saying before, I'm an economist, I lead a group of economists. You give me infinite time, infinite data, I'll take it. But we have neither. So, and we need to be operational, follow the operational cycle, which is fast. So that means that in many of the category we're looking at, for instance, in the effect on markets, we use data, of course, but we use it to proxy in terms to understand and track how these effects on market, for instance, from knowledge spreads occurs. And in this part of being operational, it needs to be predictable. So something that it is understood with the organization how things are scored. So this is why we have very specific guidelines on how things are scored. The tool is run by a group of experts, but we have specific guidelines. And readable, so that we can have conversation in the decision-making process. Finally, we say consistent and comparable. We have a very heterogeneous portfolio. We finance from big infrastructural project to mid-sized corporate. And we use similar architecture. The rating system can be slightly differentiated, but because we have to have an overview of how the portfolio get composed and sub-portfolio get composed. So comparability, of course, is clearer when we look at certain sector, but we also want to have an overall view of the score. As I mentioned, is a key decision-making factor for us. The portfolio approach means that we look at the impact rating and a financial contribution rating, and each transaction needs to comply with a certain threshold of impact rating and financial contribution rating to be eligible. So for us, it's an eligibility tool and goes into our committees for decision making. And we also use this combination to explain internally why a transaction entered into our portfolio. So very quickly, what makes up the score? Already mentioned. So there's an element of economic analysis, which include looking at direct effects on direct beneficiary and market and systemic effect, such as the innovation spread of knowledge, testing new regulatory framework, or creating market through market linkages and other elements. The stakeholder analysis is very much focused on inequality. Of course, the rating will score higher if the benefits are mainly go to excluded population, either for the GDI, gender and diversity elements. It could be elderly people, vulnerable and poor, or small and micro enterprises. Those are elements that will give a higher score in our stakeholder analysis. Sustainability analysis. We want a transaction to be sustainable, so financially, otherwise no impact will happen. So we look into that because that affects the long-term sustainability, in addition to our returns, of course. And ESG sustainability. We don't allow for compensation from benefit to ESG, let's say, cost. So it needs to be a completion with our ESG standards in order to be eligible, or the tool will not allow you to go ahead. And finally, we look at additionality. So our contribution, both in terms of the financial, what we put in terms of financial, direct financing and mobilization, and technical assistance. So the score ranges between 0 and 100. To be eligible, a transaction need to comply with either a 50 or 65, depending on the financial contribution. And as I mentioned, also include an assessment of the strategic alignment. Final, one feature that we really like a lot, the tool is also, as I mentioned, used as for supervision, is recomputed yearly. So every year we recompute the score, looking at how the operation achieved the milestone in the result matrix. So for each objective, we have result matrices and targets and milestones. And if there is a deviation from the expectation, then is rescored. And we use this deviation in the rating. It's rescored anyway, but if there is deviation in the rating, we use that deviation to define if the transaction is on track, is in alert, or in problem. We like this very much because this is what allows really us to have an active management of portfolio. So we can focus on transactions that they say are slightly off track or start to go off track, and see if we can do something to correct, have a conversation with clients, at least learn what is happening so that we can feed back into the structuring and selection of transactions and keep building a portfolio that overall deliver the results that we want. I'll stop here. Happy to take questions. I know it was a lot for this time, but back to you, over to you, Diane.
Thanks so much, Alessandro. And all three panelists do have publications that they will provide. We'll put that in the chat at the end, but also they will be posted on the Impact Principles website, because this is a lot of information, because these are very evolved, impact dashboards. So we go from IDB Invest, which is a multilateral development bank, to British International Investment, which is a development finance institution, and Hiltje.
Thanks, Diane. So maybe before diving in, similar to Alessandro, for those unfamiliar with BII, I'll say a few words about who we are. So we are the UK's development finance institution, like a bilateral institutions, focused on investing in Africa, Asia, and since recently also Caribbean. We have a portfolio size of around £7 billion, which is invested across different financial products as well as sectors. As part of our latest 5-year strategy, which we launched at the start of 2022, we updated our organization-wide strategic impact objectives to invest for productive, sustainable, and inclusive development. And as part of this strategic refresh, we also designed a new impact scoring system to kind of recognize and incentivize investments that are likely to contribute most towards those 3 objectives. Before sharing a bit more about the kind of how the tool works, I'll say a few words as well on the kind of key, let's say, design features, which is helpful to understand, like, what's the role, what's the purpose of the tool, but also like what does it do, but also and what it doesn't do. So first, it's primarily like a portfolio tool for us. So in line with the impact principle number 2, which complements our deal level impact tools. So it was designed to help us build a balanced portfolio that in aggregate kind of helps us to deliver against our objectives. So that means that we have a target at the portfolio level, but we don't have an individual deal threshold or hurdle. Secondly, it had to be predictable and pragmatic. So predictable in the sense that for origination purposes, it's very clear, like, what drives scores up, what drives scores down, and pragmatic in that it uses information that we were already collecting during our due diligence processes, and also that the tool can function in cases where we perhaps don't have perfect information. Then credible but simple. So it's grounded in our impact framework, and it really picks up some of the key features, but it doesn't give us like the full picture of a deal. So for that, we have our deal level tools, which provide a lot more nuance and are also part of the investment committee meetings. The tool had to be externally assurable, so it has to favor objectivity as well as replicability. That is also because for us it links to internal incentives, which I'm sure we get to in the discussion as well. And then finally, similar to IDB, it has to be consistent over time. So we score ex ante, so from the point of commitment of investment, and then we rescore over the lifetime of the investment ex post based on the actual outcomes. So with that in mind, so a quick summary then of how the tool is actually designed. So every deal that we've made since 2022 onwards receives a total impact score, which ranges from -1 to 10. And this total score is the sum of a productive, sustainable, and an inclusive stop score. They're weighted equally, basically reflecting that we care equally about those 3 objectives. And they indicate to what extent like an investment aligns with each of those 3 goals. So starting with the productive score, it has 4 elements. So first we look at what's the primary development need, or the SDG, that the investment is contributing to. So it could for instance, be access to power or food security, for instance, and then the degree of need in that respective country. So we've used kind of public data sources to segment countries into kind of lower, medium, high, or very high need. And so based on what the investment contributes to, what country it is in, it will automatically get assigned like a rating based on that. And then we look at the intensity, which is another way of saying like how much impact are we achieving for every dollar of investment compared to our sector benchmark. So is it above the benchmark, in line, or below? And then an investment can receive additional points here if it meets certain criteria for indirect productive impact. So related to economic enablers, so sectors that help many other firms become more productive. So for instance, digital infrastructure, but also investments that have the potential to catalyze new markets and help markets function better. So that's the productive score. Then we have the sustainable score, which awards like the highest scores, so a 3 or a 4, to climate finance investments, for which we use the MDB methodology. And if it doesn't qualify for climate finance, the score depends on how emissive the investment is. And then finally, we have the inclusive score. So first, where our investment like primarily reaches lower income populations, and we have information about their poverty levels, for instance, collected during surveys and due diligence, but sometimes we can use proxies through company data, for instance, plot size for landholding size for smallholder farmers, for instance. The inclusive score will be based on the percentage of people that live under $6.85 PPP per day. But if this information is unknown, or if the investment has like broad-based economic impact, then, so for instance, like a power plant, we will use the default country score instead, which is, again, like segmenting countries into 4 different categories based on their GDP per capita, the poverty gap, and the fragility status. And then finally, the inclusive score will have or receive additional points if it meets certain like gender and diversity criteria. So for gender, we use the 2X framework, which I'm sure many people on the line are familiar with or using. And then we have our BOLD framework, which focuses on Black African ownership and leadership for our Sub-Saharan Africa portfolio. So I'll stop there. So as Diane said, like we'll share like a publication if you want to find out a little bit more. We also published our annual review yesterday on our website, so which also tells a little bit more about how we fared in the first year in 2022. But thank you. Back over to you, Diane.
Thanks so much. And we will start to address questions after Veronica speaks. So Veronica, please provide an overview to how BlueOrchard approaches impact scorecards.
No, thank you. It's interesting. I can see a lot of commonalities. So first, I'll start as well introducing us. So we are a global impact asset manager. We started operations over 20 years ago. And we have dispersed, around 10 billion since inception. We invest mainly in emerging and frontier markets, and we manage funds that focus both on social and environmental objectives. And so given all the years we have doing impact investing, we have started this scorecard and measurement journey quite some time ago, a few years ago. I think from our experience, we can say that, it's something, and our tools, I would say on average, every 3 years, we revamp significant revamps. And I would say that the latest sort intense revolution internally was when we split up our sort of social impact measurement tool into basically 2 scorecards. One was that focuses on ESG. So we have a rating system that really focuses on measurements, the ESG risks of a company. But then we introduced at this time a dedicated impact scorecard that it has a scoring system from 0 to 100, and then we also have attached to it and associated to a range of a score, a rating. So the ESG rating, we do it per organization that we invest in. And the impact scorecard, it's something that we do for every investment. And I clarify this because we can invest, as I said, we have different funds that have different sustainability objectives. So we can have one fund, for example, that focuses on improving education in Africa. That's one of the mandates that we have. Another fund that could focus on improve, MSME resilience, and that's on another fund that we manage, and the intents there are quite different. And so this is why it's for each investment that we make that we need to do this impact scorecard. The impact scorecard we also developed in-house, also to answer one of the questions that were asked at the beginning, Diane. For us, it's a matter about a lot about consistency on how we are measuring the impact potential. So it's also forward looking. We do it ex ante. We also use it for monitoring. I'll explain this a bit later. But for us, it's a tool that it's forward looking in the sense that we want to assess, before we invest, a few things. So one is how much positive impact we're expecting to reach with this investment. We also try to see and make sure that it's a very strong alignment with the sustainability objective of that particular mandate where we're, that is making this investment on this specific fund. The scorecard is based on the IMP framework. So we started this one, I think 5 years ago with the development. We are now going through a new iteration, so we have made some updates, but basically the score, first on the what, if we're familiar with the IMP framework, this is basically the assessment of the sustainability objective and the impact intent. And this is quite important because this will also define all the rest, and which KPIs, for example, will need to be included, how this will be measured. It really is defined depending on the what. It's if the intent is on the social side, if it's on the environmental side, this will change all the possibilities and the options that the scorecard will bring. The how much is also quite important for us. We have here the KPIs. These are already mapped to the SDGs as well, so we can then extrapolate and measure and quantify the contribution to the SDGs. Here on the how much, not only we select the KPIs, but we look at the potential. So here is this, okay, in the future, where do we expect to go? So we try to, when we select the KPIs, we see, okay, let's imagine how many beneficiaries we have on that receive climate insurance to the poor and vulnerable. We will see how many they reach today. We will see, T-1, so a year ago, T-2, to see somehow what has happened, what's the history. And we also look at the future. Again, we want this to be forward-looking. And these projections are what we will call somehow the targets of this investment on where we want to be. And this is the part that we will use for the monitoring purposes that we will do after, because we will collect these KPIs then on a quarterly and annual level, depending on what KPI we have, and we will measure this progress towards achieving these targets. And we will do a very similar to what you, Alessandro, described. We will then qualify this if you are, over achieving the target, if you are, on track as expected, if you're below, and then if we believe that we will not achieve the target. And only if we think that the rating is not reflecting the impact potential that we assessed ex ante, we will change it, but not otherwise. This has also, well, maybe we will discuss this later, but the way we first of all set these targets, that we try to do this, of course, as much as possible with projections that come directly from the company. But we are also learning because, as we know, there are different scenarios that can happen, and then on the monitoring part, and then here we come with another part of our job, which is how we define success. So if you are 5% below that target, what does this mean? But it's an important discussion that we have whenever we are doing these monitoring processes internally. Another part of the scorecard is the who. And this is, of course, who is receiving this impact. The higher the need for us, the higher the impact potential, as my colleagues have shared. And here it's also, for example, on the new iteration that we have on the scorecard that has received the most attention on our side, because it's the context part. So, and a key part, for us to succeed is, there's a lot of, as much as we have tried to minimize this qualitative assessment, it is at the end of the day a rating. It has a lot of qualitative assessments, but what we have tried to do is to minimize this and to put context assessments and data depending on the theme, depending on the country, depending on the factor that we are assessing. So now we have a very thorough assessment, context assessment that is guiding the rating system that we have. Then we have also the contribution part. This we have also split it up. This is we will include here these positive and negative externalities, as has been shared by my colleagues, and we will also see, for example, if this mandate, are we providing what are we giving them? Why are we different? Are we providing technical assistance or anything else that we are considering to support and to maximize the impact potential of this investment? And finally, we also, the score mainly will come from this combination of weights between the how much, the who, and the contribution. The what was just sort of to match the impact intent with the mandate of the fund. And then you have the risk section, and this section will somehow be a factor that will reduce the rating depending on the risks that we see. So that's also something that the risk, we started really measuring them in a standardized way since we introduced this new scorecard. And finally, I will just say two things. So first is that in BlueOrchard, what has worked better for us is to have this impact scorecard done by an independent impact team. This allows, to minimize conflict of interest, and it has actually supported a lot of very good discussions with the investment team. We will have thresholds per investment. So, and all investments that we do before they go to committee, they need to have an approved impact score. So at the end of the day, if an investment doesn't fit the impact criteria, it's like a veto, because it cannot even go to a committee. And we require this for all our investments. I'm not sure how long I have spoken, Diane, so maybe back to you.
No, that was wonderful. Between the three of you, there are a lot of overlaps in your approach to impact scorecards. Obviously, it's going to be tailored to your specific type of investing and your communities that you're investing in. There is one thing that flowed through all three, is that the impact management project's 5 dimensions of impact is widely used by both public and private sector investors. And I would say of the impact principles signatories, virtually all of the private sector investors incorporate the 5 dimensions of impact to a certain extent in their impact management frameworks. So I'd like to ask a question and it can be addressed by all of you. It seems like your systems have evolved over time, because as you get more experience, it's you know what you need to change. And BII, you just kind of revamped yours. And Veronica, you said that BlueOrchard, this is part of your new impact scorecard system. So how do you expect, do you see these continuing to evolve over time? And do you think that the industry will incorporate more kind of proxies or benchmarks, third-party providers to get the data that you need for these scorecards. And one question that has come up, how is SFDR affecting your scorecards? Have you had to make some amendments to it to take into account new regulatory requirements? That's a big question, but all of you have some time to answer it. So Hiltia, start with you.
Yeah, so maybe about like this question about how things evolve over time. So we actually pre-2022, we had what we call the development impact grid scoring system in place, which was much simpler in the sense it looked at the level of development of the country, again segmented into 4 different, and then because our impact mandate was very much focused on job creation, it looked at the labor intensity of the sector, which worked very well for that previous strategic period. But then things that we care about, like climate, gender diversity, for instance, weren't captured in there. So we felt we needed to update the tool. So in that sense, it was like more of an evolution, I would say, compared to the previous tool. And also how it works around incentives. So that was something that the organization was used to as well. I think, I mean, now for this strategic period, like we've made like a strategic decision to keep the design as much fixed as possible, because it does take time for organizations to change, to build your origination channels. And so we don't want to tweak that too often. And in addition, we want to keep comparability. So an investment we make today, we make an investment in 2 years' time. If the rating changes, the system changes, then obviously it's not comparable anymore. So I would say that we probably will only consider some kind of key design changes when we go into our next strategy period. So for instance, if our mandate changes or the markets we are in, or some of our strategic priorities, and we want to reflect it again in the tool. So I think that is sort of kind of from a kind of a high level design standpoint. But then we are updating or continue to build out, I would say, some of the underlying tools or like toolkit to actually implement the system. So for instance, you mentioned benchmarks. So we use that for the productive score. We continue to build those out, and we can plug them into the system, but also inclusion proxies. So what are good proxies to help you assess whether or not stakeholders live on the poverty line that you are working with. So those are obviously things that we can continue to build out within the current system. I think probably that has been some of our biggest challenge, like the lack of benchmarks externally, because the more that exists at the industry level, the easier it is to plug in and compare yourself against other institutions. So I think the 2X challenge, for instance, has been really great for that. So I hope, and I really welcome like the GIN working on benchmarks, but also other institutions to come out with more of these tools that we can adopt and hopefully also contribute to. I'll leave the SFDR question for someone else.
Thank you. Well, with that, we'll go to Veronica. And Veronica, if you could also incorporate, have the impact principles helped support your impact rating system? You know, we've been around for 4.5 years now. So if you could just provide some information about how the impact principles may have influenced the development of your tool.
No, they did, and in fact, they came in at the right time, because it was around that time that we were also introducing this concept of having a scorecard for each investment, which, I mean, now it's part of our day-to-day and nobody questions it. But at the time, we were having only one tool, and then we were splitting them up and having 2. And there were, of course, concerns. You know, can we, scale impact with integrity, as is always our motto. I mean, with 2 tools, how is this going to work? I mean, maybe it will delay investments, and in the end, I think it's been great, and we use the principles as well to say, I mean, this will help us a lot to measure the evolution and to monitor the success per investment that is made, because I think with the other tool that we had, we were managing at portfolio level, but not necessarily to on the monitoring per investment side. So I think it did help to frame the discussion and push for the changes that were required. So in that sense, I think yes. In terms of how they're evolving, I think as we see, the more we have, you know, I mean, on the poll, you said that many of us are using these in-house tools. So it's difficult, I would say, and I could imagine that for external investors, that it's difficult to make comparisons of what is high. There's also such a level of I mean, the qualitative assessments that you have depending on, you know, this lack of benchmarks. So if you're assessing, I mean, for us, one of the challenges on the how much section, you know, if you're reaching 100,000 beneficiaries, is this high? Is this low? Is this medium? So all of this, it's quite relative. And this is why we have spent so much time building this context, these internal benchmarks that we have on some sectors, like on the financial industry and financial inclusion sustainability theme. We have a lot of data that's how we started in BlueOrchard. So we have managed to build some benchmarks, you know, that are quite specific and really help us. But this also needs to be linked to the objectives of the fund, you know, at portfolio level. So it's important to have all of this in mind. And I can understand that we need some more time to evolve on this, but we also are very happy that Jean, for example, is working on these benchmarks so that we can compare. I think it's also will alleviate many of, you know, investors, for example, concerns. Shall I also tackle the SFDR question?
That would be wonderful.
Because I think here it's also, you know, the fact that we had this impact tool. I mean, we developed it at the time we were doing our first also assessing the impact principles. It did help us be prepared, and we were, you know, SFDR caught us really in a good place in terms of assessing what is required. And this monitoring part that we do for the SFDR periodic disclosure is really based on this impact on monitoring assessment that we do that comes from this impact scorecard. So as I mentioned on the how much section, we have defined the KPIs, which is important for SFDR, and this contribution that and the link to the contribution of each investment to this SFDR sustainability objective is done at this stage. Then we have also the targets. So, and we are measuring the progress towards achieving these targets per investment. And this is what we use. And this, the summary of this assessment is what we have used for these periodic assessments on SFDR. So I think it's something that it's very useful.
Wonderful. Thank you so much. Alessandro, I'm going to shift the question a little bit for you and ask you, are you looking at, when you're talking about looking at the ex ante and ex post outcomes, you're looking at positive, are you also monitoring negative throughout the process for the potential negative outcomes? Is that incorporated into your system? And also BlueOrchard explicitly has two scorecards, one for ESG and one for impact. How do you, I don't think you have two different scorecards. So is ESG one segment of your scorecard? If you could answer those two questions.
Well, let me start from the second. We do have a separate ESG assessment. The ESG analysis factor into the deltas as an element that is factoring, but it is a separated group and a separate assessment that is conducted. So it's a thorough assessment being conducted in that part. It's not the same thing, but it's one element that is factoring into the delta assessment. When we look at the yes, every year when we re-score the tool, every factors that ex ante we thought had a relevant impact on the score, and that could be affecting the expected impact. So either that be positive or negative, that is reassessed and reevaluated to see if something changes. That, for instance, there could be sometimes we may enter into industry where there is some level of tariff protections. We may have concern about supporting. Well, in some cases we don't. We simply don't work in those industries. But or in other cases we may have some concern about, for instance, an implicit tax on consumers due to the sector, due to the protection it has. No, so we can either decide not to enter, because when we factor that, the social cost into our analysis, we find that is not what we want. There's an implicit subsidy to the producer from the consumers, or we may decide, okay, no, this is viable, and there is maybe a plan by the economy that we are assessing to reduce those tariffs and reduce those implicit taxes. So that is something that, for instance, we keep monitored in our revision of the transaction to see if the operation is going in the intended direction. So this is, let me say, this is complex, and is something that, of course, required to have data and assessment and sometimes proxies. So and this is what we're trying to do, but we really try to have that assessment ongoing, ex ante and during. Maybe if I can touch a little bit on the change. We had experience to going through different cycle. Something that was mentioned is that you want to keep the tool stable for a while. You want to have a comparability. That is something absolutely. So we go usually through cycle where you have a big revamp and then adjustment at the margin of the tool. So that is so we have in year 8. So we are mature within for a revamp, and so we're taking 1 year now to redefine certain things. In 2025 and then 2024 we will launch the new tool. But in the meanwhile, we're fine-tuning the instrument while maintaining that time series. And the experience we had in the past when with this big jump is to create this sort of transition matrix. So because we want to keep the ability to monitor the portfolio. So how you translate the old tool into what we call it a synthetic delta, so we can retransform into a rating that then we can keep applying on the legacy portfolio. That is super important. Not create these breaks into your ability to follow, especially because the active portfolio can be active for a while. So you want to be able to keep managing that. That is something we experienced in the past. It is time consuming, but it's worth it because then you can keep managing your portfolio without discontinuities. I'll stop here.
No, that's very helpful. A question that's come up, and it's something we discussed in preparing for the webinar, are these, I mean, your tools seem very advanced and very, they really do help you in your impact management process, but there's always some challenges, things that aren't quite where you want them to be. So could each of you describe what are the pain points, in your system? And could it be the alignment, tech, resources, the cost? Are some things just not captured by your current impact rating system? So if each of you could speak to that, Hilde, if you'd like to start.
Yeah, good question. So I think there's a few things to consider, if you're considering adopting a scoring tool. I think for us, it was definitely when we did this latest redesign, take time to prepare and really test. So when we calibrated the tool, we tested it on more than 400 existing portfolio companies, as well as pipeline at the time, just to make sure that it really works in your investment process. We had to recalibrate some things during that process as well. We used 1 quarter where we soft launched the tool. So we started to put it into the IC papers, but it wasn't yet kind of counting. So that helped people to get used to the system as well, but also it allowed IC members, investment committee members, to understand how to use it during the IC discussions, what role it should play. The other thing I would say is take time for training. So we did both in-person training and engagement with different teams, but also sort of e-learning modules that went out to the entire organization. So I think all of that took time. So we took about a year to really from concept stage to implementation. And I think that was really valuable. So do plan ahead, I think. In terms of so that's more getting ready. And as a result, maybe doesn't causes as much pain points now. I think probably one challenge is so when you have one single metric, which for us appears on the front of the investment committee paper, alongside as well an ESG rating. So to an earlier question, we keep those separate, like a risk rating for ESG, but also a contribution or additionality rating. So that all appears alongside risk and return and other metrics. But having, as I said earlier, we have deal level tools that are much more granular and really important and capture more nuance and qualitative information. But having this one metric is incredibly powerful and useful, but it can also sometimes start to dominate decision making a little bit. So we had to really make sure that we really kind of made sure that we would put enough emphasis on the elements that were maybe not captured by the score. So that brings me to the other point. So what's not captured in our tool is the more qualitative elements. So for instance, contribution and additionality, as we found it really hard to really codify it. Given we go every year, at the end of the year, we go through an external assurance process. So codifying additionality is much harder than, for instance, if you're in this country, in this sector, that's easier to standardize. So I think, so that was deliberately kept separate. Also impact risks, we have not included in the score, but are captured in our deal level analysis, which is structured alongside the IMP dimensions. Yeah, so, and impact depth, sorry, last element. So that's also not captured well by the score, but is very much part of our deal level analysis. So again, that's a bit of the trade-off. If you really wanted to link to incentives, and in our case also remuneration, you have to keep it very objective. That means that there are certain elements that can't necessarily be assured very easily externally, but you really want to make sure are part of the investment decision-making process. So ensuring that that balance is right is really important and can be a challenge.
Great, thanks so much. Veronica, would you like to speak to this?
Sure, and we are going through the process of updating the tool. So I think I will echo what has just been said about the need for training. It's important. I think what we have done, for example, in the last 2 weeks is to have several sessions with the different investment teams to show the changes on the tools. It is important that even though, I mean, as I stated before, it is the impact team that is the owner of the tool. It's super important that we are very transparent on what constitutes positive impact for us and how this is measured, so that they can have a certain level of predictability of what we are expecting to see. So it's important to do this, and they will also help us on the testing period. So we are doing testing, and I think it takes, I mean, for us, around 4 months to test, and we have certain targets on the number per theme that we need to test. So it does, this is something that, of course, for us takes a lot of time, and also another reason why we don't want to go through this process every year. But whenever, we have important updates that we have to go through it. What is missing, what we want, and what we can still improve. I would say maybe 2 things. So first is on the benchmarking. I think we have made huge progress with certain parts of the scorecard. For example, all that is related to financial inclusion. We have a lot of data, and I think we feel very confident on how we're scoring. There are some, parts where we still feel that we need more data around. I mean, we can say, on certain themes on climate adaptation, for example, we lack benchmarks and lack data of what means success in terms of impact. So I think there it's something that we wish we had more. One area where we had more, I would say also something that took us time to learn and how to grasp it is on these projections on these targets that we put per investment. If we are, we need to have this balance of being ambitious, but not too ambitious that we need to tell, okay, this is where we want to be. But if on the monitoring part, if we're too ambitious because we push our investees to achieve impact, then, on the monitoring every year we'll say you're not reaching your targets. So we need to have this level of being realistic, but also ambitious at the same time. And this we are learning. And also it's important that we, again, here involvement with the investment team to understand these projections, how much these projections are aligned with the business plan of the companies. No? So I would say this. And also on the risks section, something new that we have introduced in the new version of our tool, because an impact rating is one number, and yes, sometimes and we do include the risks, and it reduces the rating overall, because the higher the risks, the lower the score will be and the lower the rating. But we found, and I felt that in many cases where there were some risks, because we are investing, sometimes, there are external risks that are quite high, that could, bring the scoring down. The potential was so big. And I felt that this was not really properly telling the full story to the investment committee. And so now we put the impact rating that is risk adjusted, but also below we also put the rating without risk, so that committee members can also see the full potential if things go, of course, well.
Thanks so much, Veronica. And Alessandra, I'm going to let you wrap this up so you can address the question and anything else that you think that you'd like to add that we may have missed.
No, sure. And let me start by saying that I subscribe to everything that was said. I'm very pleased to see such an alignment in terms of topics and maybe just a few highlights. So I think the challenge, the constant challenge and pain point of this kind of tool is these are tools that are meant to summarize something that is complex into a number. So this constant tension between wanting the tool to capture many dimensions and being readable and understandable in its component. So I think that is the element that we see as a continuous, and appreciate everything was said about the continuous training, explaining the tool, and particularly bringing, in our case, bringing again the attention to the sub scores, the components of it's not just the overall number, but the overall number is so important in many ways, because it's the one the decision are taken. Also, is part of our remuneration for our, not for my team because manage it, but so also have a separate team, but for the investment office is part of their menu of elements that are looked at in terms of their rewards. So maintaining the balance is not easy. So look now, for instance, looking at Delta 2.0, there where we're looking for refine tuning this element of the how many concepts we're including to the tool and how it's readable, and refocus the attention also on the subcomponents. So that is one thing that and for us, maybe this is a bit specific for us, for organizations that have a very heterogeneous portfolio. It's also to have the modularity, the flexibility of a tool that allow us really to go from assessing large infrastructural project to medium-sized corporate. So you have that flexibility, and maintaining standardization, because you want to be cost effective and you want to be able to really compare well what is comparable. So that is another thing that for organizations like us is more challenging. I guess for organizations that are more focused in certain sectors, areas, or type of investment can be a little bit easier. And maybe if you're very, very, very focused, you don't even need a very sophisticated impact rating, because there are 2 or 3 elements you can really track as a measure of success. But when your portfolio becomes more complex, there where you may go towards something like this. Element that we like very much and want to see more is for instance, we see an increasing interest by partners, clients, co-financier on this kind of tools. What we like was mentioned internal benchmarking. For instance, we provide to our clients a benchmark of their performance against our portfolio, using also our impact rating tool, and that has been very much appreciated, especially for the one that are most interested into the impact they are having. There are more and more of our clients, they're not just receiving this or something that is interesting to us, but not to them. They're more and more say, this is something I want to understand better for me, for how I operate. So we saw that as a great evolution in the last years. As an industry, how this evolve, I truly hope that the next years we've been developing different version of this. The IMP, the impact principle, provided some guidance and point of reference in the way these things are designed, but maybe then the application and the implementation has been different. I really hope that in the next year we start to converge towards a sort of common core for the industry, or maybe a couple of common cores, so that comparability increase, because we talk a lot about benchmarks. That is super important. I want to see more of this tool go to the test of monitoring transactions. See, many of the things are out there, very much focused on the ex ante. I think that if we talk about impact management, so how you manage a portfolio, it's not only how you build a portfolio, but also how do you see that evolving, and how you take decision how to build it based on what you see in terms of performance. So I really hope we can move towards some definition, some common core elements, if not a common rating. But I will close here. So back to you.
That was a perfect way to summarize everything, because the goal is really to help the market move towards best practices, and so that more things are comparable and consistent. And in that vein, we have in the chat posted some links to IDB Invest impact assessment and management framework. And when we send out the webinar, which will be posted on the Impact Principles website, as will these publications, if BII and BlueOrchard also have any publications that they'd like us to send out, we will include that in the email to all of you. But thank you so much for being here. The first webinar on investor contribution is already posted on the Impact Principles website, and we will have our future webinar will be on impact-linked incentives, which is an increasingly important topic in the impact space. So thank you all for joining. Thank you, Alessandro, Veronica, and Gilce, for a wonderful conversation. Very deep, very involved in a lot of information. So these publications will help everybody kind of dissect the whole discussion. Thanks again. Bye-bye.
Thank you. Thank you so much.
Thank you so much.